Selling low and buying low sounds like losing twice. But what if I told you that when you're moving to a bigger home, it can actually help you come out ahead? Today I'll show you a real Toronto example with every fee and tax included, and we'll see step by step if the numbers work in real life. Quick question to start: if the dollar gap between your current place and the next place that you're trying to get got smaller, would that change how you feel about moving? Picture two steps on a staircase. The bottom step is your current home, and the step on top is the bigger home that you want to get. When the market is soft, both steps come down, but the taller step usually drops more inches. That means the step up between them gets shorter. In housing words, the dollar gap between your sell price and your buy price shrinks. That smaller gap can make upsizing possible right now, not someday. And so before we crunch the numbers, ask yourself, what would a bigger home change in your day? An extra bedroom, a small yard, a quiet place to work? Let's use clean numbers so it's easy to follow. You sell a home for $500,000 that you bought 10 years ago with a 20% down payment. So you started with a $400,000 mortgage. Over those 10 years of normal payments, your balance today is about $263,000. That means you've paid down about $136,000 of principal. And that paid down part is called equity, the piece of the home that you now own because you kept making payments. Now for the new place, you're buying in Toronto for, let's say, $700,000. You're putting 20% down, so that's $140,000, and a new mortgage of about $560,000. When you buy in Toronto, you pay two land transfer taxes, one in Ontario and another in Toronto. At a $700,000 purchase price, each land transfer tax is just over $10,000. So together, that's just under $21,000. We'll use $2,000 for legal fees on the sale and $2,000 for legal fees on the purchase. If you had to guess, after all those costs, do you think you'd still have cash left over for paint and small fixes around the new home? Let me know. When you sell at $500,000, you pay off the $263,000 you still owe. You pay a 5% commission, which is $25,000. You also pay HST on that commission, so that's an extra $3,200. Your seller legal fee is $2,000, and because you're ending your mortgage term early, let's say, there's a penalty. For a variable rate mortgage, a common penalty is 3 months of interest. We'll model that on the $250,000, which works out to be about $2,300. So now what's left in your hand after closing? Your net sale proceeds. Take the $500,000 sale price, subtract the mortgage payout, the commission, the HST on that commission, the legal fees, and the penalty, and you're left with about $204,000. That's your fuel for the next move. Imagine holding a check for $240,000. Where would you put it? Straight into the down payment, or would you keep a bit as a safety cushion? For the new home at $700,000, you need $140,000 down. That's 20%. Add in the two land transfer taxes at $10,475 each, which totals to just under $21,000. Add your $2,000 buyer legal fee. Your cash to close is just under $163,000. Now, compare that to the $204,000 you're getting from your sale. After you close on the new place, you still have about $41,000 left over. Don't treat this as profit, but instead treat it as your buffer. The money that keeps you calm when you need to paint, maybe buy some new furniture or appliances, or even need to call a plumber within the first month. So now what about the monthly mortgage payment you'll actually feel? With a $560,000 mortgage over 25 years, let's use a common fixed rate in the mid 4% range right now. Your monthly principal and interest lands around $3,100 to $3,250. If we plug in 4.59%, the example payment is about $3,141 a month. If your payment was around $3,100 a month, would your monthly budget feel okay or a little tight? What would you change to make it fit? So what did we just show? You can sell for $500,000, pay everything, buy at $700,000, cover both land transfer taxes and legal fees, keep a reasonable cash cushion, and move into a bigger place that fits your life better. This works because of that staircase effect. When prices fall, the bigger home often drops more dollars than your smaller home does. So the step up is shorter. And when prices rise again by the same percent, the bigger home often gains more dollars too. There's another reason this can be smart in the soft market that we're in right now. You usually have more choice and less rush. Days on market tends to be longer, which means you can add helpful conditions. A financing condition gives your lender time to finish an approval. An inspection condition brings in a pro to check out the home. For condos, a status review lets your lawyer read the building's papers. With time and conditions, you make clearer choices. If a seller gave you a choice between a quick close and fixing one thing that matters to you, which would you pick and why? Put it in the comments. Let's talk about life and not just the numbers. The best part of moving up is how your daily routine changes now, not 5 years from now. A third bedroom means fewer bedtime fights with the kids. A small yard means the kids can run around, the pets to play, barbecues in the backyard. A simple home office means you stop working at the kitchen table. Over 5 to 10 years, those little daily wins add up more than people think. And if you're handy or just patient, slow markets often hide good bones. Homes that need light work and are priced a bit lower. Fresh paint, better lighting, a few new handles on the cabinets, and some basic landscaping can make a simple house feel like your home. That's value you create on top of whatever the market does. Be honest, if you had to pick one lifestyle win, what would it be? The extra bedroom, the yard, or the home office? So now let's talk about the risks. First, the monthly payment has to fit real life. Food, kids, car, savings. Even though prices are lower than the peak, rates aren't at those ultra low levels from a couple of years ago. Do a quick stress test yourself. Look at your payment at today's rate, then look again with the rate 1% higher. If both are okay, you're good. You can also compare a 3-year fixed, a 5-year fixed, and a variable rate and choose whatever makes you sleep better. Second, keep a cash buffer after closing. In our example, that left over $41,000 helps a lot. If your cushion would be near zero, pause on non-essential renovations and let your savings recover first. Third, the mortgage penalty. We used a simple variable rate method, 3 months of interest. If your loan is fixed, your lender may use IRD, the interest rate differential, which can be much higher. The easy fix is to get your exact penalty in writing before you list your home for sale. If it's large, time your sale closer to your term end or use a longer closing. Fourth, your timeline. If you plan to move again in 1 to 3 years, fees and taxes can eat your gains. Upsizing works best when you expect to stay 5 to 10 years or more, so normal bumps in the market don't matter as much. Which risk worries you more? Payment, cash buffer, penalty, or timing? This plan is a great fit if you truly need more space now, and also if your income is steady and you'll likely stay in the home for years. It makes sense when the kind of place you're buying, whether it's a townhouse, semi, or detached home, has dropped more in dollars than the place that you're selling. When there's enough inventory and reasonable days on market so you can negotiate, and when you can qualify at today's rate and still keep 6 to 12 months of cash as a safety net. It's better to wait if your leftover cash would be basically zero, your job is shaky, or if you already know that you might move again soon. The math can be right and the timing could still be wrong for your life. Both matter. If you stayed 5 to 10 years, what would matter most to you? Space, schools in the area, commute to work, or monthly comfort? So now let's jump ahead a little bit. What about prices in 2026? Keep it simple. If both homes rise by 10%, your $700,000 home gains $70,000, while your old $500,000 home would have gained only $50,000. Same percent, bigger dollars because your base price is bigger. Even if entry homes bounce faster in percent, you've already won on daily life. You're in the space that you needed, and over time, the bigger base tends to add more dollars. The most important thing isn't guessing the perfect month to buy. It's being in the right home and holding it long enough that normal wiggles don't shake you out. If the market went up 10% from here, would you rather own the $500,000 home or the $700,000 home? Tell me why. Okay, so now here's what you need to do. Take your own real numbers, your exact mortgage balance, your lender's written penalty quote, your commission and HST included, both land transfer taxes for your target price, your legal fees, and your down payment, and run the same math that we did. Money from sale, cash to close on purchase, leftover buffer, and new monthly payment. Do your own personal stress test at today's rate and at 1% higher, just to be safe. Decide the order of your moves, sell first with a longer closing, or buy with a condition on selling, or use bridge financing if the timing is tight. Bridge financing is just a short loan that covers the gap between when you buy and when your sale money arrives. Finally, make the decision with your 5 to 10 year self in mind. Space, school, commute, and how calm you feel about the payment. If this video helped you think straighter about sell low and buy low, hit subscribe only if it gave you real value, and drop your numbers or your biggest question in the comments. Thanks for watching, and I'll see you in the next one.